I'm going to tell you something that's going to sound completely backwards, especially if you've been grinding away at your trading screens for hours every day. The traders making the most money aren't the ones staring at charts from market open to close. They're not the ones frantically placing dozens of trades every week. And they're definitely not the ones constantly adjusting their positions based on every market hiccup. The wealthy traders, the ones consistently building serious wealth year after year, are actually doing less, much less. And today, I'm going to show you exactly how they're doing it. Most people come into trading with this Hollywood vision of what success looks like. You know the image. Multiple monitors glowing in a dark room, someone frantically clicking buttons, making split-second decisions worth thousands of dollars, the adrenaline pumping through their veins. It looks exciting, it looks intense, it looks like the path to wealth. But here's the brutal truth nobody wants to hear. That's exactly how most traders lose money. The constant action, the non-stop decision-making, the emotional roller coaster of trying to catch every move in the market. It's not just exhausting, it's financially devastating. Think about the last time you overtrained at the gym. Maybe you went 7 days a week, pushed yourself to the absolute limit every single session, refused to take rest days because you thought more was better. What happened? You probably got injured, burnt out, or at the very least, you stopped seeing results. Your body needs recovery time to actually build muscle and get stronger. Trading is the same way. Your capital needs time to compound. Your strategies need room to breathe and work. And your mind needs space to make clear, rational decisions instead of reactive, emotional ones. The traditional approach to trading is fundamentally flawed. We've been sold this idea that active equals profitable, that busy equals productive, that more trades equal more money. But when you actually look at the data, when you study the traders who've built real, lasting wealth, you find something completely different. You find people who've mastered the art of selective participation. They've learned to identify the situations where they have a genuine edge, and more importantly, they've learned to sit on their hands during all the other times. Let me paint you a picture of two different traders. Trader A wakes up every morning at market open, scans through hundreds of charts, places 10 to 15 trades throughout the day, constantly monitors positions, adjusts stop losses, takes partial profits, adds to winners, cuts losers quickly, and goes to bed exhausted after the closing bell. Trader B wakes up, checks their predetermined watch list of maybe 20 stocks, waits for 1 or 2 specific setups they've thoroughly tested and trust, places 1 or 2 trades per week at most, sets their stops and targets, then goes about their day doing other things. Fast forward a year. Who do you think has made more money? If you guessed Trader B, you're starting to understand the power of the 80-20 rule in trading. This principle, also known as the Pareto Principle, suggests that roughly 80% of your results come from 20% of your efforts. In trading terms, this means that a small fraction of your trades will generate the vast majority of your profits. A small number of setups will account for most of your edge. A small amount of focus time will produce most of your actual value. The rest is often just noise, distraction, and a slow drain on your capital through commissions, spreads, and inevitable mistakes. The mathematics of trading are working against the active trader in ways most people never even consider. Every time you place a trade, you're paying a cost. Commissions, spreads, slippage. These might seem small on any individual trade, but they compound dramatically over time. If you're placing 50 trades a month and each one costs you an average of $10 in total friction costs, that's $6,000 a year just to play the game, before you've made a single cent in actual profit. Meanwhile, the trader making 10 trades a month is paying $1,200. They start the year with a $4,800 advantage just from doing less. But the costs go beyond the obvious financial ones. There's the psychological toll of constant decision-making. Every trade you make depletes your mental energy, your emotional reserves, your capacity for rational thought. It's called decision fatigue, and it's real. Studies show that after making numerous decisions throughout the day, people become worse at making subsequent decisions. They take shortcuts, they become impulsive, they revert to emotional rather than logical thinking. This is why judges are more likely to grant parole in the morning than in the afternoon. Their decision-making capacity gets depleted. Your trading decisions suffer the same fate when you're constantly in and out of positions. Let's talk about what the 80-20 rule actually looks like in practice for a trader building real wealth. First, it means identifying the 20% of market conditions where you actually have an edge. Maybe you're exceptional at trading breakouts from consolidation patterns in momentum stocks. That's your 20%. Everything else, all the range-bound choppy days, the sideways grinding markets, the unclear technical setups, that's the 80% where you should be doing nothing. The discipline isn't in taking more trades. The discipline is in waiting for your setup and passing on everything else. I've seen traders transform their results completely by simply cutting out the marginal trades. They stop trying to force opportunities that aren't really there. They stop convincing themselves that this borderline setup might work out. They develop the patience to wait for the truly high probability situations. And what happens? Their win rate goes up because they're only taking their best setups. Their average winner gets bigger because they're not spreading their capital across 10 mediocre opportunities. And their stress levels plummet because they're not constantly monitoring multiple positions. The second application of the 80-20 rule is in your actual preparation and analysis. 20% of the work you do, studying charts, reading news, analyzing indicators, that 20% is producing 80% of your useful insights. The question is, which 20%? For most traders, it's the time spent reviewing their own past trades and identifying patterns in what works and what doesn't. It's the time spent deeply understanding a few key setups rather than superficially knowing dozens. It's the time spent on risk management and position sizing rather than endlessly tweaking entry techniques. Here's something that might shock you. Some of the best traders I know spend more time planning their trades in the evening when markets are closed than they do actually trading during market hours. They're doing the heavy analytical lifting when there's no pressure, no real-time price action to trigger emotional responses, no urgency to act immediately. They're identifying their potential setups for the next day, determining their entry criteria, calculating their position sizes, setting their stop losses and profit targets. All the important thinking happens in a calm, rational state. Then, when markets open, execution becomes almost mechanical. They're simply waiting for price to confirm or deny their predetermined plan. This is the opposite of how most people operate. Most traders show up at market open with no plan. Scan for whatever looks interesting in the moment, make decisions on the fly based on how they're feeling, and wonder why their results are so inconsistent. They're trying to do the analytical work and the execution simultaneously, which is like trying to write a speech while delivering it. Sure, some people can improvise well, but most of us do our best work when we separate the planning phase from the execution phase. The wealth-building power of doing less also comes from the magic of compound growth on your winners. When you're constantly in and out of trades, taking profits quickly because you're worried about giving them back, you cap your upside potential. You might catch a 2% move here, a 3% move there, but you never ride the trades that turn into 10 or 20% winners. Those big wins, those are what build wealth over time. But they require patience. They require you to do less, to resist the urge to constantly tinker and take profits too early. There's this concept in trading called letting your winners run and cutting your losers short. Everyone's heard it, everyone nods in agreement, but almost nobody actually does it. Why? Because doing it requires doing less. It requires not touching a winning trade just because it's made you some money. It requires sitting on your hands while a position goes in your favor, even when your brain is screaming at you to lock in the profit before it disappears. The traders who build wealth have learned this discipline. They understand that their job isn't to constantly do something. Their job is to do the right things at the right times and do nothing the rest of the time. Let me share a specific example of how this plays out. Imagine you identify a stock breaking out of a multi-month consolidation with strong volume and clear resistance turning into support. You enter with a position sized appropriately for your account. Your stop is set based on the technical structure. Your initial target is at the next major resistance level. Now, most traders will start second-guessing themselves the moment the trade moves a few percent in their favor. They'll check the price constantly. They'll read every news headline about the company. They'll adjust their stop to break even too quickly. They'll take partial profits earlier than planned. All this activity, all this doing, it usually results in them exiting a position that would have hit their full target if they'd simply left it alone. The trader following the 80-20 principle does something radically different. They place the trade, set their stop and target, maybe set a calendar reminder to check on it in a week unless their stop is hit. Then they go do something else with their time. They're not watching every tick. They're not refreshing their brokerage account every hour. They've done their analysis, made their decision, and now they're letting the trade work. This isn't neglect. This is strategic detachment. This is understanding that most of the time, your interference makes things worse, not better. Risk management is another area where the 80-20 rule is incredibly powerful. 20% of your attention on protecting your capital produces 80% of your long-term success. Yet most traders spend the vast majority of their energy thinking about entries, studying indicators, looking for the next hot stock, and almost no time thinking about position sizing, portfolio heat, maximum drawdown limits, or their overall risk exposure. This is backwards. The defensive side of trading, the part where you determine how much to risk and how to protect yourself when you're wrong, that's where fortunes are preserved. The offensive side, picking the right stocks, that's important too, but it's secondary to survival. Think about professional gamblers, specifically poker players at the highest levels. The best players don't play every hand. They fold the vast majority of hands dealt to them. They're patient, they're selective, and they only commit serious money when the odds are heavily in their favor. Trading is remarkably similar. The market is dealing you hands constantly, every minute of every trading day. Most of those hands are trash. Folding, doing nothing, waiting for the strong hands, that's how you win over time. The amateur sits at the table and wants to play every hand because they're bored, because they came to gamble, because doing nothing feels like wasted opportunity. The professional knows that folding is often the most profitable play. There's also a powerful element of opportunity cost that most traders ignore. Every trade you take, every position you enter, that's capital that's now tied up and unavailable for other opportunities. If you're constantly fully invested across multiple positions, you have no dry powder when the truly exceptional setup appears. The trader doing less, the one sitting mostly in cash waiting for their specific conditions, they have capital ready to deploy when others don't. They can size up on their highest conviction ideas. They're not spreading themselves thin across mediocre opportunities. They're concentrated on the few situations where their edge is strongest. This concentrated approach might sound risky to some people. They've been taught that diversification is safety, that you should spread your bets. And in long-term investing, that makes sense. But active trading is different. You're not building a retirement portfolio. You're seeking to exploit specific market inefficiencies and patterns. In this context, focus beats diversification. It's better to have 3 high-conviction trades that you understand deeply than 15 positions you're kind of guessing on. The trader with 3 well-researched, carefully monitored positions can actually manage their risk better than the trader juggling 15 different ideas. The mental game of trading is where doing less becomes truly transformative. Trading is one of the few professions where doing nothing is often the correct action, yet our brains are wired for activity. We feel like we should be doing something productive, making decisions, taking action. Sitting in cash while markets move feels like missing out. Watching a watch list without pulling the trigger feels like cowardice. But these feelings, they're your enemy. Learning to be comfortable with inaction, with patience, with waiting, this is perhaps the single most valuable skill you can develop as a trader. I've watched traders go from struggling and stressed to profitable and calm by making one simple change. They committed to doing less. They picked 1 or 2 setups they would trade and nothing else. They limited themselves to a maximum number of trades per week. They established criteria that had to be met before they could even consider entering a position. These constraints, these limitations, they didn't restrict their success, they enabled it. By narrowing their focus, they deepened their expertise. By reducing their activity, they increased their profitability. Here's a practical framework for applying the 80-20 rule to your own trading. Start by analyzing your last 50 or 100 trades. Look for patterns. Which setups produce the majority of your profits? What market conditions led to your best trades? What time frames worked best for you? Now here's the hard part. Eliminate everything else. If you find that 80% of your profits came from trading momentum breakouts in the first hour of the market, then stop trying to trade afternoon reversals or end-of-day fades. Focus exclusively on your 20%. Master it completely. Become absolutely elite at that one thing. Next, look at your preparation routine. What activities actually improve your trading decisions versus what's just busy work or entertainment disguised as research? Maybe you spend hours reading general market news that doesn't impact your specific strategy. Maybe you're constantly adjusting indicators that you never actually use in your decision-making. Maybe you're checking your positions every 15 minutes when your strategy is based on daily charts. Cut the low-value activities ruthlessly. Protect your mental energy for the decisions that actually matter. Then examine your trading frequency. Are you taking trades because you genuinely see an opportunity that meets your criteria? Or are you taking them because you're bored, because you feel like you should be active, because you're trying to recover from a loss? Start tracking not just your trades, but your motivation for each trade. You'll probably find that your best trades came from patient waiting followed by conviction. Your worst trades probably came from impatience, boredom, or emotion. Once you see this pattern clearly, you can start to interrupt it. The transformation that happens when you embrace doing less in your trading is remarkable. Your stress decreases dramatically. You're not constantly worried about multiple positions. You're not experiencing the emotional whiplash of winners and losers throughout the day. You're not exhausted from hours of screen time. Your actual returns often improve because you're taking higher quality trades with better risk-reward ratios. Your win rate tends to increase because you're more selective, and perhaps most importantly, you start to enjoy trading again. It stops being this grinding, exhausting daily battle and becomes a patient, strategic pursuit. Building wealth through trading isn't about heroic effort or constant activity. It's about strategic laziness. It's about identifying the specific situations where you have an edge and doing absolutely nothing the rest of the time. It's about quality over quantity, focus over diversification, patience over action. The market will be here tomorrow. There will always be another trade. The question is whether you'll still have capital and mental energy left to take it. So here's your challenge. For the next month, commit to doing less. Cut your trading frequency in half. Spend that saved time reviewing and learning from your past trades instead of taking new ones. Be more selective about which setups you'll even consider. Sit in cash more often. Let winning trades breathe without constantly adjusting them. And watch what happens. You might be surprised to find that doing less leads to earning more, stressing less, and actually enjoying the process of building wealth through trading. Because at the end of the day, the goal isn't to be the busiest trader, it's to be the wealthiest one. And those two things are rarely the same person.